You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tussaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. And now, get ready to hit the option block.
All right, everybody. That rockin' tune means it is time once again for the option block. Everyone's favorite. I know it's certainly my favorite. Hopefully it's your favorite bi-weekly source for all things options related. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from a little thing we like to call around these parts, ye old Options Insider Radio Network. Recorded, live streamed, call it what you will, from the mecca of the optionverse, at least for the foreseeable future. Of course, scenic and sunny, particularly today. Not too bad out there today. Going to be nicer even this weekend. Chicago, Illinois. And, of course, we produce a wide array of content starting tomorrow, soon to be 14 programs on said network. And where can you find all of that juicy, delicious goodness? Well, of course, the easiest place, your one-stop shop, is the mothership, the flagship, theoptionsinsider.com. Kicking off there, you can find all of our programs there. You can also find them via iTunes, TuneIn, Stitcher, and so on and so forth down the line. Of course, you can always find us via our mobile app as well. And of course, while you're listening, while you're streaming, while you're doing whatever it is you do while you're listening to the show, make sure you send us your questions, your comments, your insights. We love to hear from you guys. And joining me on the old program today, starting off in the land of Maine, the duchy, nay, principality of all things New England, we have the Rock Lobster himself, Mr. Andrew Giovinazzi. Mr. Rock Lobster, welcome back to the Option Block program, sir.
It is a pleasure to be here on what might be the sleepiest day of 2016.
It is a sleepy one. And speaking of sleepy, we usually also now turn to that sleepy hamlet known as St. Charles, Illinois, but Uncle Mike seems to be the latest to be plagued by this ongoing and, should I say, quite annoying Skype bug. So we'll see if we can get him on, listeners. We'll work through this. Meanwhile, though, we're going to keep on rolling right on into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
All right, everybody. Welcome to the Trading Block. This is, of course, the portion of the program where we break down what was moving, what was shaking, what was rocking, what was rolling in the day that was from a broad market perspective. And at the top of the show, it wasn't a heck of a lot of rocking and rolling on the old show today. We had about a roughly 10 handle range out there in the S&P, pretty much closing the day, unched right around the 2083 level or so. Most of the other major indices pretty much following suit, unched or slightly up on the day. The VIX cash exhaling yet again, right about the 13.5, a little bit higher level out there right now. Mr. Rock Lobster, I met some resistance on my downside estimate on volatility views last week for the VIX cash. I think I said somewhere around the 14 to 14.5 range on last week's show, and I was by far the lowest, And now here we are going into Friday, and it's looking like actually I was wildly optimistic from a vol perspective.
I laugh at their no lowness on the VIX. I know I like your. I think after today, considering you have this Doha round in Saudi Arabia for OPEC, I thought we'd see a little bit of a bid for vol, but we don't have one. I just find it amazing. Nobody really cares.
Yeah, it is kind of odd because it's not like we're in the quiet period. We are in the teeth now, the beginnings of earnings season. Alcoa kicked us off, that market mover known as AA, kicked us off earlier this week. So now we are officially in it. We have some names coming out in a wee bit. We can, in the Around the Block, we'll talk about those. Next week is really kind of when the rubber meets the road. Tomorrow we have, I believe we just have CITI, the major one before the bell tomorrow. This one closing, let's say right around, I think about the 45 handle or so. Let's pull it up. Yeah, pull right about the 40, tick under the 45 handle. Up about, actually decently on the day, up about 75 cents or nearly 2% on the day. This is the one that's pricing in. They're pricing in close to $1.50, about $1.40 out there on their straddle. So a little over 3% out there in CITI land. That's not exactly rocking and rolling, but it's not a sleepy earnings cycle either for good old CITI. So we'll see what that may do and how that may portend for financials and for the broad market. If we see a terrible number out of them tomorrow, then maybe, who knows, perhaps my low bid on vol will look cheap by tomorrow afternoon. In terms of the broad market, as we're trying to resolve Uncle Mike's myriad technology issues, looking here at what we saw today, like I said, it was pretty quiet day. We had about a 10-handle range out in the S&P, which certainly isn't quiet in and of itself, but comparatively, compared to what we've seen in recent months and weeks, it's pretty quiet. And in terms of where we're sitting right now, we're looking at pretty much, like I said, about 2083 or so out there in S&P land. That's up about 14% from the nadir back in February, and we're hovering pretty close, spitting distance of that all-time high, right about 2% or so off those highs out there. Since Uncle Mike isn't here, out there in the commodity land, we see oil catching a bit of a bid before that meeting of big producers over the weekend, and that's after, of course, it was off a little bit after extending its run about 13% over the last 3 or 4 sessions or so out there. So easing it back a little bit today, but overall it has been bullish time out there in crude oil land. We were examining some of that skew on an earlier program on the network this week and some other things we were doing, and it was looking longer term. It was still pretty much puts, but the calls were getting a little bit of bid. And near term, in the wild and wacky front month out there, it was pretty much pick 'em. Calls and puts, smiley all over the board. So people were kind of playing coin flip going into this weekend's number. We'll see how that plays out. Gold taking it on the chin a little bit too, off of nearly 2%, about 1.7%, right about to about 27 or so an ounce out there in shiny stuff land. And Mr. Rock Lobster, as I attempt to divine what is up with Uncle Mike's technological peccadillos, why don't you regale us with your take on the day that was today, sir? What caught your eye in today's activity?
Well, the hardest part was trying to just find something to do. I mean, as far as activity goes, I think a lot of my clients are just looking at how low all the vol products are going and having a hard time believing they could go lower, which they could. I think the only place where there's a ton of premium is in the May future. I'm guessing that future is bid because of maybe this weekend, and it could go crashing down come Monday, Tuesday. So I'm looking for any kind of a setup into that for tomorrow. And a little short of vol products right now, just kind of pressing this future premium a little bit. but I am long some upside calls in the vol products as well. So it's kind of like a strangle that's just sort of in the money. The financials all of a sudden, which looked ugly, kind of caught another bid today. As the greasy meatball was saying, they've been sandbagging earnings. So, whatever they came out with looked pretty good. So for whatever reason, all of this monetary shenanigans like we've been talking about, what's funny is, was there any Fed speak this week? And I don't think I think the answer was no. There was no Fed speak from a bunch of governors or the chairman or anything that really upset the apple cart, and we rallied all week. So maybe the recipe is just we get a rally if the Fed keeps its mouth shut until the next meeting. And really, that's about it. Overall, it seems like the financials do like the earnings. So, and they're bidding them up, and that's about it. The only other thing I would say is that gold sold off real suddenly today. I don't know why, but it just did. And the miners kind of gave it back. I think there was some just profit taking. But I would not be surprised to see that move continue, because whatever drove gold, I mean, there's negative interest rates in 30% of the G7 right now or something like that, or in the EU. So, if they're going to charge you to put money in a bank, maybe gold doesn't look so bad.
The mattress is looking preferable right now.
I do not understand it, but people are actually putting their money in banks and they're getting charged for it. So, and why isn't the dollar rallying? Because you actually at least you get some kind of interest if you deposit money here, and the dollar's at an all-time low. So, or not an all-time low, but very close to year lows. So mostly, if I'm noticing anything, it's just the weirdness of things moving in directions that you shouldn't be moving in. So I guess we'll let confusion reign supreme. I just put on smaller positions and wait till things become a little more, clear. Because right now it's a little opaque, I gotta say.
And speaking opaque and a little bit weird and hopefully clear, we are now joined by Uncle Mike Tusaw, by that most magical of technologies known as telephone. Uncle Mike, are you there, sir? Can you hear me?
I think I'm here. Can you hear me?
I can hear you, sir. The Skype god's not smiling on the lovely hamlet of St. Charles today. Maybe we'll get that fixed as the show progresses. But meanwhile, better to have you on in some way, shape, or form than not at all. And before the Skype gods smack you down again, what caught your eye in today's activity, sir?
Well, yeah, like Andrew, like Andrew had said, with gold coming down a bit, I think it's more of a technical kind of a sell-off, and that I think gold is going to have a hard time getting through the 120 mark. It's going to take a few times to get through it. I wouldn't be surprised to see a little bit of a pullback in gold with GLD. Right now we're short the 114 puts, and if we did touch down at that level, I would probably roll down again. But the next roll down, I'd like to get into gold below 110 in the GLD. But in the meantime, I think we're just kind of puttering around a little bit. I think it's just most prudent to just simply sell some puts instead of trying to get in, get out. I like the idea of selling puts in the near term. Some other things that are catching my eye at this point, just in general, the S&P, we are rallying. Did not have too strong of a rally today, but I think that we have the 213 mark in SPY that'll be the 213 and some change is the all-time high that was made about a year ago. I think May 22nd, if I remember correctly, was the all-time high, the most recent all-time high in the S&P, and we're still kind of right where we were almost a year later. I think that's going to be a big stepping stone to get through it. But in the meantime, I think we're just kind of going in a sideways channel, and like I've said on this show many times before, I wish the market would do something already. At least in January when it was selling off, it was just somewhat entertaining. But now it's just my kidneys are way too healthy. I need the BVI to come up again.
Well, while you're waiting for that BBI, maybe we can look ahead to some other items. There's some interesting, talking about alphabet soup, SIBO is about to crank out some interesting new indices. Have you looked at these at all? Mr. Rock Lobster kind of just got a new release coming out of SIBO land, and they're known for throwing some interesting things against the wall to see what sticks. When Uncle Mike said BBI, it of course makes me think of BXM and all the other variously named indices and products that they've disseminated over the years. Some interesting, like the covered call and the put right and things like that, and others a little more esoteric and not really being consumed by the masses. Now they're coming out with the S&P 500 Buffer Protect Index, measures the performance of a hypothetical S&P for SPX, I should say. Options provide annual targeted returns. This is actually incorporating the Flex, which is something where, if you're not familiar with Flex, listeners, they're kind of effectively, they're kind of like bringing some OTC kind of custom type trades onto a listed lit venue. You can call up the exchange or use electronic services now and designate a different month and strike in series. And if you have enough size and money, you can get it done, and people will make a market for you. So it sounds like this Buffer Protect is going to start incorporating some of those Flex. I think the goal behind this is to try to replicate kind of what some of the insurance companies do, getting out there in the longer term part of the curve there in terms of how they are hedging. They're saying here their goal, each of these indexes and the Buffer Protect series is designed to track the returns of a hypothetical investment over a period of approximately 1 year, seeks to, quote, buffer protect against the first 10% of losses due to a decline in the SPX, while at the same time setting a capped level to the upside. The capped level of each of the indexes is determined on each annual roll date. So it sounds like maybe they're writing a 1 year flex call and then levering in some puts. I know there's a lot of these things coming out these days. These roll across your desk at all, Mr. Rock Lobster, and what are your thoughts, if so?
None of these, I mean, I guess I just listed them. None of them have.
Am I putting you to sleep, sir? Is that this exciting?
Literally, this day was so brutal. I couldn't reach the mute fast enough. They crank these things out. I think they end up being good for studies like 5 years later. But as far as what are you going to do with them? I mean, just after teaching retail traders for almost 4.5 years now, the too complex products, I think, are I don't know. I think sometimes we can get a little too complex and a little too cute, and then it makes it sort of difficult. But maybe there will be a use for this flex product somewhere along the line to somebody. Could be.
Yeah, when they start slinging BXM and others have had a hard enough time, and those use relatively standard listed products. When you start adding in layers of flex and getting out into the leaps and stuff, it gets a little bit wonky, perhaps a little bit esoteric for your average user. But still, yeah, it's good to see they're trying these things. I'm kind of with you. We'll see. Like I said, we'll see how these things gain any traction. Speaking of gaining traction, you guys may remember a few years back, listeners, when BATS, the much lauded and some criticized exchange out there, tried to go public. They kind of didn't go so well for them, and in the process, they cut off Apple at the knees, chopped them down, and that, of course, caught a lot of people's attention. So not only did they have to dial back their own IPO, but they screwed up a lot of trades and everyone's favorite name at the time, good old AAPL, so that really got a lot of ire pointed their way. Fast forward a few years, and they're trying it again. They're tilting at that windmill yet again tomorrow, actually, so it'll be Friday, April 15th. Usually tax day, not so much this year, which is nice. And they got to sell have more stock than planned, actually, about $253, about $250 million in stock, about 40 million more than they originally planned. BATS, of course, taken many forays into the options and volatility world. They launched their second options exchange late last year, so now they have two. They also didn't launch, but announced their SPY-X, Spikes, SPY-9, call it what you will. They're kind of VIX competitor. That hasn't really been approved. Nothing trades on that one yet. But so they're taking many forays into the world of options. we'll see. Hopefully this IPO will stick. It's a rare thing to have an IPO not stick, let alone when it happens from an exchange group launching their own stock. So hopefully this will be they won't have a repeat of things to come. Speaking of things to come, I think we'll keep rolling on with the show here into some, I know, stuff you guys like to hear, the weird, the wild, the wacky. It's time for the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, everybody, welcome to the Odd Block, the portion of the program where we break down some of the weird, the wild, the head-scratching, the bizarre, the downright just unbelievable paper that we're seeing lighting up ye old options market. Going to kick things off with a name we haven't talked about in some time out there in the fashionable realms. We don't get to fashion that often. Good old Kate Spade, ticker symbol Kate, K-A-T-E. A very appropriate ticker there. Closing today, $24.34, off about half a buck or so on the day. This is the name that does, let's see how much paper there, about 2,000 contracts a day. So from an odd block perspective, not bad paper. And then today, really lighting it up to the tune of nearly 18,000 contracts. And what caught our eye was a bit of a funky three-way, kind of analogous to another trade we talked about last week, Mr. Rock Lobster, where it looks like people are perhaps playing with a wee bit of house money, and they're coming in and they're rolling, and they're not just rolling out and up. They're also putting on an upside short leg as well, a bit of a vertical instead of just the outright long, which is kind of intriguing, saying they're still bullish, they still have the love, but perhaps not quite as much love as they had before. So let's kick it off here with what we saw today was the APE 25s going up about 5,000 times versus the May 26-29 vertical, also 5,000 times. Looks like paper selling on the apes, buying the 26s, and again selling the 29s, hence that vertical I was mentioning before, about 5,000 and change open on the ape 25s, aka why we think they're closing about 2,000 open on the May 26s, and pretty much nothing open on the 29. So it seems like Mr. Rock Lobster, a bit of the old up and out with an extra upside kicker. And looking here at a recent chart of good old Kate Spade, particularly over the last few months, from the February onward or so, even into mid-January, this thing has pretty much been straight up from about the 15, 16 handle all the way up to where it is right now, right around the 25 level that it was trading as of the open this morning, closing about a little over 24 today. So this thing's had a nice run to the upside. Our friend there on the 25s, they were at the money / in the money this morning, and getting them off while the getting's good, and then deciding to roll up a little bit. Not the craziest trade we've seen, Mr. Rock Lobster. Also a bit more conservative because he does have that upside leg. He's not just reestablishing. He's also not doing what we see with a lot of house money rolls, which is, doing it 1 by 2, selling one, and then, hey, it worked out well for me once. I'm going to buy 2 now, so I'm going to do 5,000 by 10,000 on the next strike out in May. He's not doing that. He's keeping it pretty conservative. I'd say this gets a fairly decent, whether regardless of what your view is on the underlying. In terms of the execution, I think it gets a decent level on the savvy scale. How do you fare, sir?
I think I'm just glad I could find a name where the symbol matches the name of the company for you. So
I love that, sir. It rings off, pushes all my buttons.
Mental breakdown. I love it when it's the same, like Kate. How can you mess that up?
It's just something right with the world when that happens.
Don't the people that invent those symbols know you have a radio show to host? I mean, come on, for crying out loud.
They're not considerate people at all.
I think this is a reasonable trade. Starting to see a little more bullish paper. It's funny, you don't see any bullish paper at 1850 in the SPX, mostly because the volatility is 35. But once the volatility gets cheaper, people start coming back. So yeah, I think this is a little house money roll, buying the call spread. I'm going to check the open interest on it tomorrow, but it feels like, closing one and opening another and looking for some love in that very not competitive world of fashion, because there's no competition in fashion.
No, it's just printing money all day long, and the audience is very loyal. They tend not to change brands on a moment's notice, and it's just generally a fun place to do business, I think.
Yeah, I think you just wheel your wheelbarrow in and fill it up.
All right, moving on from the realm of fancy ladies' clothes into the realm of another area we talk about a little bit more here on this program, tech in particular. Now we're looking at good old Seagate. Been around for quite a while, still kicking out there, ticker symbol STX. Closing today, taking it on the chin, shall we say, closing out $27.11, off nearly $7, or about 20% on the day. So yeah, not a banner day for good old Seagate. It's a name that's doing about 14,000 contracts a day. Today doing about 94,000 contracts. So a wee bit more, shall we say. And what caught our eye, we were talking about rolling earlier. Seems like rolling is kind of the order of the day here again. This time not to get more love, as we were saying earlier, but instead to get a little bit more downside, covering my you-know-what. In particular, it was the SEP 2520 put spread that caught our eye, going up 10,000 by 12,000 times in 2 blocks over there on NYSE Arca. About 10,000 and change open on the 25s and about 8,000 and change open on the 20s. So both pretty sizable strikes, but not enough to match the paper out there on the 20s anyway. So it looks like this is a bit of a roll. Our friend here taking his protection off the table at the 25 handle, rolling it down a little bit down to the 20 land. I guess maybe he didn't want to have those meteor puts, or perhaps he thinks this is kind of a momentary aberration, a pretty aggressive aberration if that is indeed the case, and he wanted to take advantage of the opportunity, take some money off the table, and readjust at a less relevant strike. Doing a little bit more size, too, on the downside, again, indicating perhaps he's got some house money to burn, maybe not on his underlying, but certainly on his puts, and these are probably usually done in conjunction with a large underlying positions. Looking here, and today's move aside, this one has been kind of vacillating around a little bit. It was flirting with similar levels not that long ago. It was only back in late January where it was trading right around these levels, 26, 27, 28. Then it had a decent run to the upside, got up to about 36, nearly 37 or so. Not that long ago, a few weeks back, and then since then, particularly today, just getting its legs cut out from under it. We'll see if this continues out there. We saw, as you might imagine, a flurry of paper across the board. Whenever a name has a move this aberrant, we usually see options volume spike, but this was definitely the most meaty trade that we identified out there, and certainly also in line with what we're seeing out there in the underlying, the big move to the downside. Mr. Rock Lobster, anything to add here on this sizable roll down with a little bit of extra kicker there on STX?
Yeah, this is one of these ones where we were looking at this in the chat room today. This stock's down like 50%. So I don't know if they're going to cut the dividend or something. All they did was say they kind of lowered their outlook. I guess, what is it? Everybody's in the sandbagging business for earnings, I think, in 2016. So this looks like they're going to have one of those cheap stock, decent yield plays, but this looks like a roll for could be a role for protection against an equity position, but usually when somebody buys more puts, it's kind of more speculative. They want to kind of juice the downside a little bit. So it looks like this trader has been right already. So maybe there's just maybe Seagate just starts plunging to new lows for the year. So It just doesn't look great for this company. That's all I'm going to say on this one. It looks not good.
Yeah, whenever their wings get clipped by 20% in one day, I think we could charitably refer to it as not good. Again, using that main euphemism you are so famous for up there in northern New England. All right, moving on to our final name / victim of the old odd block today. This has been a frequent offender in the odd block of late. This is Freeport-McMoran, ticker symbol FCX. Of course, they are a natural resource company, hence their frequent offense in the odd block. It's been a somewhat tumultuous sector, of late. This is the name actually doing a little bit lighter than their ADV. It's a name that's been averaging a pretty healthy 94,000 contracts a day. That's pretty robust paper, only doing a mere 71,000 today. So light paper in today's activity. So it wasn't the overall size or a huge direction of the move. The underlying pretty much closing unched on the day, off about a dime. So it wasn't an underlying move. It wasn't a huge spike in options activity that really caught our eye, as well as it was in particular one fairly sizable trade that drew our attention. It was verticals, the order of the day, Mr. Rock Lobster. It was the May 12, 14 vertical going up when we first started profiling it about 7,700 times. Paper putting up the 12s for 55 cents over the 16s the 14s for about 16 cents. Easy for me to say today. Total on the day, about 10,000 of the 12s and about 10,000 of the 14s as well. So he did them pretty much even on both sides. A ton of open interest on the 12s, about 18,000, only about 5,000 open on the 14s, hence why we think maybe this is a bit of a roll on this 12s. Or perhaps Mr. Rock Lobster maybe we'll agree to disagree on this one. Maybe we'll do a little counterpoint on this one. Do you disagree vehemently? You think this is all open in paper? What does your diehard Maynard blood tell you on this one?
My diehard blainer what, and I looked at this. So if the guy's closing the short contract, the 12s, and then he's going to open with a 16-cent sale on the 14s. That I would say that is a stretch for yield, wouldn't you?
Yeah, we've seen some people go into some pretty extreme lengths. I wouldn't be jumping all over that one anytime soon. Unless he's sitting on a ton.
And you're closing the 12s for 50 cents. If you're long the underlying, why bother? That doesn't make any sense.
This thing has been at those levels not that long ago. It was about late last summer, the last time FCX was flirting with the 14 handle, about early to mid-July or so when it was trading around those levels. Had a brief spike again to about 13.5 in October. And ever since then, has kind of been had a nice sell-off in January down to the 4 handle in the teeth of all of the madness earlier in the year. So this thing has posed quite a rally since then. Whether it can recover to those levels, I don't know. And clearly our friend here, if he is indeed opening on the 14s, doesn't think it's going to be reaching those lofty heights again anytime soon. And if it does, he's probably willing to dump the size amount of stock he's probably sitting on. Would you concur, Mr. Rock Lobster?
That's kind of what it feels like. So I'm still thinking again. I'm thinking somebody's buying it. They're getting long, and whatever's going on with this little short-term commodity squeeze is not over yet.
Speaking of not over yet, this show is not over yet. We got a lot more to go, including a lot of your questions and perhaps, if you're lucky, our answers, because it's time. It's Thursday. It means it's time for the mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, you guys know the drill by now. Thursday means we turn our mics over to you folks, let you guys dictate the terms for not the rest of the show, but a good chunk of it, as we answer your questions, your comments. You can hit us up. No shortage of ways to do just that. Surf on over to the website, post a comment, use the website feedback form. A lot of you guys like to do that. or, of course, the old-fashioned way, the email way, questions@theoptionsinsider.com, or via our myriad social media platforms, Options on Twitter, Options Insider on StockTwits, or The Options Insider on Facebook. Pick your poison and have at it. Or, of course, for those of you in the old chat room, we had a robust crowd out there on Monday. I think it's a little lighter today because today's activity wasn't too much in the marketplace today. But for those of you in there, you can also use the MixLR. So if you're listening after the fact, you say to yourself, hey, how do I get at these guys live? Ask them some questions during the show. Really bug Mark and throw him off his game. Well, the easiest way to do that is just to grab the Mixlr app, MIXLR, and just search for us in there. Options or Options Insider will come up. Or follow our links that we tweet out on Facebook before the show every Monday and Thursday. And then you can ask us questions live. But we got a lot of questions coming in, so if you guys want to join us there as well, feel free to do so. First off, we got a mega one from a mouthful of a name, AJM. I won't do him the dishonor of attempting to pronounce his last name, even though I think I have a sense of it because it's just, it's impressive, shall we say. All right, here we go. He says, I hope you guys can calm my frayed nerves over this DOL thing. What exactly is going on? Am I not going to be able to sell calls in my IRA anymore? Since the vast majority of my assets are in retirement accounts, this would be a huge hit to my savings. Please tell me this is not the case. Is there anything I, as a retail stock and options trader, can do to help prevent this? What if I open an international trading account? Would that do the trick? Help, I need you guys to talk me off the ledge. Well, AJ, you're writing in at the right time. Allow me to walk you back from the abyss, from the precipice. If you were writing in like a week, 2 weeks ago, it may have been a different story. I wouldn't have really had as much calming words to tell you. But now here we are about a week or so close to it after the release of the Department of Labor's actual proposal. And just to set the stage, if you guys aren't familiar, it's kind of a weird and wonky story. The Department of Labor, not your typical people to crack down in the financial space. Usually it's SEC or CFTC or FINRA. This time, the Department of Labor throwing their hat into the regulatory ring and saying we want to crack down on the fiduciary standards that are out there for a lot of investment advisors and investment professionals. A very laudable and noble goal, trying to keep people from getting ripped off. What, as always happens in all of these types of things, is the baby is often thrown out with the bathwater, and that is indeed what was the case here. For some strange reason, I still don't know why they did this, including that proposal, they made a list of about 40-odd assets that they were effectively going to allow these fiduciaries to recommend to their clients. And they included a bunch of interesting and esoteric stuff, of course, stocks and bonds and mutual funds, even things as weird as variable annuities that also incorporate derivatives. Yet for whatever reason, they did not allow listed options. So people got up in arms. This battle has been being waged for the better part of the last 6 months. It seemed like going into last week even that they may not have gotten the message that they were still going to keep that prohibition intact, essentially prohibiting them by omitting them from the proposal. But then when they issued it last week, all 1,000 pages of their recommendation, pretty dense read, listeners. I encourage you, if you have any trouble sleeping at night, check it out. But the part we're concerned about here, of course, the dealing with listed options, they did address that. They are now effectively, they removed that limitation or their sin of omission, call it what you will. And now you are going to be able to keep going forward, writing your covered calls in IRAs and buying your puts or doing whatever the heck else it is with options in your IRAs. There still is, I think, some concern over options education at some broker dealers and whether that's going to be considered advice. So ironically, they may still be cracking down on your broker trying to teach you about options, which I don't think is obviously clearly not a good thing. We want more people to learn about these products, but that's a battle for another day. The main fight has been won, which is options are free and clear in your IRAs for the foreseeable future. I know we touched on this a little bit on last episode. Uncle Mike, you've been the Skype gods have forced you to be quiet. Anything you want to add on this to talk our friend Mr. AJ off the ledge here?
In terms of Department of Labor law, I think that it was one that was, I think I had mentioned on the show last week, it was good-hearted but fool-headed. I really am of the school of thought that if you're advising clients on what to invest in and what to do, I think that a majority of the time you're better off in a fee-based setting, meaning that I can tell my client that I'm motivated to make you more money. If I charge you X percent of $100,000 and that $100,000 becomes $110,000, I get a raise because X percent is higher at the $110,000 than the $100,000. However, if I am trying to pitch you a product, be it a variable annuity, a mutual fund, whatever the case may be, I get a 5% commission up front, then I don't care how you do. I already made my commission. Most of the time, I feel, and this is a very deeply held belief of mine, that in order to be on the same side of the table as the client, you need to be fee-based. And I constantly spend my days saying, how can I make more money? And how can I make my clients more money? Because if those two things happen, we're both benefiting. Whereas if I'm commission-based, then I'm just looking to sell another product. And it's kind of becomes a little bit of a, how can I put this, conflict. And that's something that I think the Department of Labor was trying to address, because a lot of times in especially 401ks, there was a lot of product-based selling that may not have been in the best interest for a lot of clients out there. So with that, I think they were trying to address that. But the problem is that somehow trading options in an IRA got pegged into this. With that being said, I mean, I had a long conversation with the Viceroy on this a few weeks ago, actually, in terms of how this might affect me and that type of thing. And just with that, the main thing is that if you're putting your client's interests first, and you can show that you're putting your client's interests first, then advisors should really have no problem with this law. I would say maybe 3 to 4% of the assets that I manage are in what's called an indexed annuity, and that's a commission-based sale. I believe it's a specific tool for a specific situation that makes sense in certain times. However, what was abused about this oftentimes is that advisors would, and just so you know, I'm putting the air quotes up with the advisors with my two fingers, would go out there and just try and pitch a variable or an indexed annuity to anybody. And it was very much a Glengarry Glen Ross boiler room type atmosphere out there in terms of just trying to pitch the product to somebody. They would have these dinners to where they would say, we'll buy you dinner. And they'd have these big annuity dinners with all these seniors aged 61 to 79, tell them about how great annuities are. And with that, they make $8 or $9 grand a pop on everyone putting in $100,000 into this annuity, and that's pretty much their business model. So with that, to me, that's not putting the client first, and that's what the Department of Labor was trying to go after. Now, what I say is that ultimately the responsibility falls upon the consumer. Ask your advisor, are you fee-based or are you commission-based? There's no wrong answer for it, because there are times where being commission-based is better, in my opinion. However, most of the time with the clients that I work with, it's more beneficial for the client in that both of our interests are on the same side of the table. So ask questions about that. How do you get paid? What is motivating you to make me more money? Or are you just out there trying to pitch me this mutual fund, and then maybe if I get a raise at work or a bonus, you're going to pitch me another mutual fund and then just work your day as a salesman? Ask your advisor those questions. If those questions would have been asked of advisors in the first place, we likely wouldn't have needed this law or this concern. So with that, I'm thankful that options are still allowed in an IRA. But with that being said, I think that ultimately, if you're using an advisor, ask the right questions, folks. Find things out that you need to find out.
Well said, sir. I'm glad the Skype god smiled upon you to allow you to to get it out. Moving on to another. We get questions all over the board here. I love our listeners. This one's from Jeremy M. He writes, "Hey folks, I thought this might be a great question for the option block. Would you mind talking about the quote limit order display rule Exchange Act Rule 11 AC 1-4. That's about as scintillating as it sounds, listeners. He writes how it can help the retail investor, how the rule is applied to SPX and VIX options. When reading the actual rule, it can get a bit confusing because it's talking about odd lots and block size orders, etc. It would be good to get your take on it. Perhaps a Rock Lobster and Mark can have interesting perspectives as former market makers. Great program. Cheers. Jeremy M. This was an esoteric one. I know about limit display. When you asked for this very specific version of it. I had to go look it up myself because surprisingly, I'm not fluent with every single amendment to every exchange act since the dawn of time. So I did look this one up, and this is effectively going back. I saw some earliest literature I saw on this was from the mid 90s. This is going back a ways. And effectively, what looks like they were trying to do here on this was requiring, market makers in particular. What they were looking at was OTC market makers requiring their display customer limit orders that are priced better than their over-the-counter specialist or market makers quote, and then to add that size associated with it to the quote. And it's funny, when I first saw this and I read this, it just seemed par for the course for me. I'm sure you encountered this as well, Mr. Rock Lobster, but this was the way we did it on the listed side of the business since I got into the business in about this time, in about the mid to late 90s. And let's say we were out in Intel and the market for whatever option was $1.20, and a customer comes in 105 bid for a 10 lot. And the order goes when they would effectively call the book, which is where they would handle all of those resting orders. And that was a 10-lot bid for 105. So guess what our crowd bid was now? 105. And that meant it was kind of an annoying thing, actually, because the customers only bid for 10. Guess who's on the hook for the other 50? The crowd bid had to be at least 50 up. So guess who's on the hook for the other 40? Hey, that would be us. So we would make these good all the time, and this became just kind of a regular fact of life. So the notion that they needed OTC to step up and do this, it's kind of funny to me because this is just kind of how I'm used to doing business. We also saw people trying to game the system. Obviously, you'd see market makers from away pits and other traders and customers loading the book up with 10 lots and 20 lots here or there just to try to get the bid up to where they wanted to sell, maybe a few hundred or a few thousand. And then they would try to turn around and ram those down your throats. That was always a fun conversation to have with the broker and the client. Yeah, we're not really there. That's just a 10 lot sitting in the book. You can take that out and maybe we'll give you 40 more. The other 950, you got to put at our actual bid. And so that was always a fun way to win friends and influence people. So this has been the way it's been done in listed options for a long time. You see this also when I was out in the SPX. Same thing. The book would list those orders. They'd be lurking in there for anyone to pick off. Out in the equity options, you also had the raise, so you had the retail automated execution system. So if it was hitting a bid or lifting an offer, it would go out automatically and transact those. I wasn't out there when the VIX options were listed, so I can't speak directly to that, but I'm assuming it's a similar process. Mr. Rock Lobster, I'm sure you encountered this as well. These random mom and pop 10 lots coming in and screwing your NBBO up all to hell and high water because they got to get their 10 lot. Curse you, Aunt Agnes from Iowa.
Now, is this just the fact that a customer order takes priority on the book? Is that this rule?
This specific one he's talking about, this 11AC1-4, is referring, I think it's specifically trying to get OTC people to step up to the requirements of the listed, where if you get a better displayed order for a limit order, you have to make that now your displayed market. And that's kind of that's what they're referring to. I don't think they don't mention priority here. It's just more of updating the MBBO.
Oh, okay. So you can't trade, like in the old days with Incident, you were talking about that, where I was fun because I used to have SEC regulators on the floor, right? And I would show them, okay, do you see my bid that I just put up for this particular stock, right? And I think the stock at the time was Cube, right? And the OTC market maker width was a $0.50 wide. It was 61 1/4, 61 3/4. But on Instanet, I have a 61.5 bid in there, and it keeps trading 61 1/4. And I was pointing out to the SEC person, I go, do you see that? I'm getting screwed. I'm getting hosed right there. I can't even get filled at a half when it's trading 1/4. And they would look at me and say, I don't know what the hell you're talking about. And there the conversation ended for me. But 2 years later, they changed that rule.
Yeah, it's a wacky world of these exchange requirements and the various minutia and rules therein. Good question. Again, I can't speak to how it's done right now In the VIX land, I'm assuming it's a similar requirement. Things have obviously evolved a little bit with the advent of hybrid and CBOE2 and all that fun stuff, so it may have evolved a little bit. But if someone's coming in with orders that are going to be resting their limit orders that are better than the MBBO, they're going to be displayed, and the MBBO is going to be updated. And they're going to make the crowd or whoever the upstairs guys stand behind at least a few of those. And with markets much tighter now and things going back and forth, that isn't as much of an issue as it once was, where a simple limit order could come in and improve you by an eighth or maybe even a quarter or something crazy, and then now you're on the hook for that better price for quite a bit of contracts, maybe more than you really are comfortable or more than you really want. You end up putting something up at fair value just because there was a 10 lot resting in the book. And all the people who out there lament about market makers ripping them off, they don't hear about the many times where we had to make you guys whole on that kind of stuff. So no love, no love for those guys there. The market makers getting no love as usual here. Let's see how we're looking on time. Well, I guess you better get rolling. We went a little bit longer on the displayed limit order than I thought, but it's a bit of an opaque thing. And now it's time for us to keep on rolling into our final segment. It's time for Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, listeners, like I mentioned at the top of the show, we're coming into it. We're coming into legit earnings season. We got CITI tomorrow. That's kind of on the financial realm, obviously. And then next week is when it really starts to pop off. A lot of the names you guys watch and trade actively and write in about are popping off next week. Of course, we got Google. We got Goldman next week. We got my old stomping grounds, Intel out there. Got IBM. Good old Beamer. Just had a big, I think, blockchain event out there. It's kind of interesting stuff going on with them. Microsoft also dumping a lot of money into blockchain. It's just the story du jour out there in tech land right now. Good old Widowmaker, a.k.a. Netflix, coming out next week as well. Southwest and United, if you're into the airline sector. And, of course, the troubled, some may say, plague-ridden Yahoo. Will they, won't they be sold? Who will buy them? What's left? What is that? What is even their core business anymore? Does anyone even know? Maybe we'll find out more next week there. So a lot of names on the horizon for next week. A lot for us to talk about. In addition to those names, we turn once again to that sleepy hamlet of St. Charles. Uncle Mike, what's catching your eye for the rest of this week into the weekend and perhaps even a peek at next week?
I'm just excited that we're talking about stocks again instead of something that the Fed's doing. I mean, with earnings seasons coming up, or I should say, well, I guess we're kind of at the beginning of it now. So with that going on, I'm excited to see earnings announcements and look at things after market to see if Amazon's going to go up 12% in just one announcement. I mean, that's the way it should be, instead of worrying about what some people in Washington think that the markets should be. I'm excited about the fact that we're not worried. I shouldn't say not worried, but we're focused on what we should be instead of what a central bank is doing. Also, actually kind of keeping an eye on the yen. The yen is something that they've really worked hard to try to devalue, but it keeps going up. So I'm continuing to watch that and wanted to see if gold pulls back a little bit more, folks. It might be a time to buy in.
There you go. Get those long gold deltas. Work your puts, Uncle Mike style there. Get yourself some long deltas in GLD. We turn our attention now to that also sleepy part of the country where the Rock Lobster is fighting to stay awake. A few more minutes, Mr. Rock Lobster, then you're done. You can take your daily nap. What is catching your eye for the rest of this week into the weekend?
You know, the adrenaline crush at the end of the day on a slow day is quite brutal. I want you to know that. I'm kind of in the Mike camp with the gold here. I don't know why gold ran so much. Maybe it's because, like I said, with banks charging people to hold money in Europe, maybe owning the shiny stuff doesn't look so bad anymore. And I do think this is just a little pullback as there's a search for more solid assets again. And you've got oil, this OPEC meeting this weekend. Let's see if anything really comes of it. Other than that, though, everybody likes stocks again. And I have learned to not get in the way of this market when people want to buy stocks. Because when I first started, the Dow was 1750. That is 1,750. So after 26 years, the market can go up. So you just get out of the way.
There you go. Getting out of the way. It's time for us to get the heck out of the way as well, listeners, because this show is coming to an end. But before we do that, let's check back in one last time with my cohorts, my partners in crime, as those rockin' chords bleed into the background. Mr. Rock, actually, no, let's start off in the land closer to home. Mr. Uncle Mike, what is cooking in the land of RCM? Coming up on those final days for IRAs, are we not?
We are, but by the time most people hear this show, it'll be done. So with that in mind, if you are a self-directed trader and you get the RCM umbrella, you want to trade under the RCM umbrella at a place such as TD Ameritrade, contact me, folks. We can get you a pretty good deal. And with that, my number is 312-212-3531, or send me an email at mtusaw@rcmfs.com.
And Mr. Rock Lobster was cooking in the land of the pit.
We have May 7th. We have a handy enough, since the Labor Department has seen it fit that you can actually trade options in your retirement account. We will be having a option portfolio management class on May 7th for beta weighting, some alternative ways to generate income, selling puts and treasuries, or being long treasury, buying calls, something like that. Different ways to finance the puts you want to buy through different strategies. So it will be there. It will be May 7th. And again, it's always that same cost. It's about an eighth on a 10 lot. And our Saturday classes have been growing. It's been very, very pleasant, very pleasant.
Glad to hear that, sir. And of course, we want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and of course, for sending in such great questions. Keep those lovely and many and varied questions coming. You guys keep us on our toes. We thank you for that, and also for everybody who tuned in live via the Mixlr app. We'd love to see you guys there as well. And we'll see you next week for more The Option Block.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.